G'day everybody, welcome to another weekly general update for the 14th and 15th of April. And we've just seen a pretty extraordinary week in the US. The volatility extremes that were achieved is something that's rarely been seen, probably only a handful of times in the last century. So really quite an incredible week. Not a lot of actual price movement, but it's just the extremes of buying percentage as against selling percentage was quite amazing. So just a reminder about the general advice nature of this information. So a quick summary of the week. The S&P lost 27 points net on the week, and as you'll see from the chart when we get there, there's a very likely an ABC pattern, which is extremely normal, is playing out quite nicely. So it all looks quite in order at the moment. As I said, it was fairly choppy action, and the market depth swung from one extreme to the other. We had three very significant down days in terms of market breadth. In other words, a lot more companies going down than were going up, and of course two up days squeezed in the middle of that. 1320 to 1340 continue to look to be the likely support areas for me, and I'm still expecting that we'll get an advance after that. I know a lot of people are calling a top in the market at the moment, but I'm just not seeing those signs at all, as I went through in the last members meeting. The ASX 200 rose 4 points on the week. That was really a bit more about timing. We had a 4-day week here, the US had a 5-day week, and I'm sure our market will be down on Monday morning. We did get a false break of the key resistance at 43.50. The price has come back into the range on the index level, but look, frankly, unless you're just trading the top 6 or 7 stocks, what the index does is really a bit irrelevant at the moment. Quite a good positive for our market, and we finished well on Thursday and Friday, was that Chinese GDP data came out, and it showed a decrease, but frankly, what does it really mean? Because 8.1%, I know the market was expecting a little bit more than that, but 8.1% is still a pretty good rate, and it's 8.1% now of a much bigger economy than China had, say, 3 to 4 years ago. So from a volume tonnage of raw materials imported, which is really what's of relevant to Australia, to me it all looks fine, and I would expect to see a reasonably soft landing in China, and I think all these doom and gloom people are going to prove to be wrong over time. Most of the large caps in Australia have been pretty lackluster and have been for really quite a long period of time. So really it's just trading the ranges in the Australian market as far as the large cap goes. We've still had a few small caps were moving. The number moving has decreased very dramatically in the last few weeks, but then you'd expect that during a corrective period. So I still think we're setting up for some good opportunities. Turning to Europe, there are tremendous social and economic problems in Europe, and I think they're probably going to get worse before they get better. But the ECB clearly is signalling that it's prepared to do whatever is necessary. So is the Federal Reserve, so is the central bank in England and Japan. So I just can't see that this is an environment this year where we're going to get a substantial correction in the market, because central banks are just going to step up and prop things up. Bond yields, Spanish and Italian bond yields started moving upwards again, which is not a great sign and indicative of the issues in Europe. But again, look, I think that's just really not going to be a major problem, because the ECB, I think, will step in and prevent that getting out of hand. US 30-year yields did look like they might have been breaking out. I said last week that we needed a bit more data, and somehow the US Fed has managed to push those 30-year yields back down again. The US dollar, meanwhile, it's had a bounce, but really it's just looking like a big choppy sideways action, and it's getting into a tighter and tighter band, which could continue for a few more months. I would expect we'll then get a breakout one way or the other, but we're probably not there yet. Now gold rose $27 on the week, and whilst we know that the short-term action is very heavily manipulated by central banks and the major hedge funds, you've really got to step back from that action and look at the fact that US money supply is growing at 20% per annum, and interest rates are effectively zero guaranteed for the next couple of years. So we have negative real interest rates, we have massive increase in the supply of money. These just are perfect conditions for gold to rise long term. So I'd really encourage you to look past the short-term action, which is really just blatant market manipulation, and keep very firmly fixed on the fact that I'm sure gold is heading higher. 1620 is a key support level. If it dipped a little bit under that, I could live with that, but certainly it would want to be fairly short-lived. And really we're looking for a break above 1690 to signal the next move up being underway. And we'll have a look at the important gold miners indices in the States, the GDX and GDXJ, which are haven't definitively bottomed and started heading higher yet, but they're certainly showing signs of reversing from a pretty oversold level. We saw oil continue just to hold its sideways pattern at the moment, and copper did break the key 380 a pound level, which is not a great sign for mining stocks. So let's have a look at a few charts. And we'll start first of all with the S&P index. And for those that have been watching this video now for some time, you've seen this chart labeled the way it is. I'm as good as convinced that we're in an advance that has not finished yet. We are currently getting an ABC correction to the downside. So we've had the A leg, which went through till about Tuesday or Wednesday of last week. We then had the bounce, which you always get because that's just crowd behavior, and now we're very likely heading back down looking for a low either 1340 or 1320. If those levels hold, I would expect that would be oversold here on the RSI, and I would think that would then clear the way for a bounce, and I'm looking for a bounce to at least 1440. Let's just have a look at the US 30-year Treasuries. You can see we did look like we were breaking out. Basically the pattern was playing out very well up until Tuesday the 3rd of April, but then it really took a sudden step change back down again last week. So yeah, it looks like the rise in bond yields, at least at the long end of the curve, is back in its box for a little while. This is the US dollar index. So you can see over recent months it's just been forming a tighter and tighter triangle, and eventually that will break out one way or the other. At this point I don't really have an opinion as to which way that might go, but certainly when it does it will be fairly influential on stock markets. Now let's have a look at gold, and this is it first of all on a weekly chart. You can see we're still caught in this large triangle, but the good news is that it's still holding those long-term rising trend lines. So my view is that we will eventually, after this mucking around in the apex of this triangle completes, that we will see gold break out and head towards 1900 and above. Just looking at gold on a daily chart, you can see we had 4 or 5 days up in a row. Did a bit of a reversal last night, but really just reversed the gains from the previous night. Now let's have a look at the Aussie market just for the record. This is the ASX 200. We had this key level at 43.50. We had a little peak above it on Monday the 2nd of April, and it then immediately reversed within the same day, so it only really broke out for an hour or two. Immediately reversed back into the range, so I would not expect to see this head any higher for a little bit of time yet. So I'm looking for this to perhaps head back down towards maybe the 4100 area in the first instance. So let's go back and so here's a chart of copper, 6 months copper. You can see we had a lengthy period here where copper was trading in the range between 380 and about 395. That did break down last week, which is a bit of a concerning sign. So we'll just have to see how that plays out over the next couple of weeks. Now, just in terms of strategy, just to wrap it up, my overall thoughts there. The S&P index, whilst you may not be trading the S&P index or you may not be trading US stocks, the movements here certainly set the sentiment for global markets, and it's sentiment that drives markets in the short term. So I always look at the S&P primarily because it helps me time my entries and exits into the stocks that I'm trading, because basically my trading is built around swings in sentiment. When we look at Aussie stocks, it's looking pretty weak at the index level, so I'm looking at trading the larger stocks, basically trading the ranges. And as far as overall exposure, I think we're in a period now where holding some additional cash to use when we get some sell-offs, I think is a really important thing to do. And I'm starting to shift my balance away. I've been playing some speculative stocks of late, particularly in the gas sector, because there's been plenty of momentum there. But I'm starting to shift my balance back towards better quality stocks that will hold up better in this increased volatility that I expect we're going to see. There's still a few gas stocks that still offer some great trading opportunities, but you really need to be more careful with entries and exits going into the phase that we're in now. So that's it for this week. We'll talk to you next weekend. Cheers.
If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.